Hi, everyone. I hope the week has been treating you well so far. Welcome to what is now the 18th TrendWatch Evenco Bloomberg Intelligence webinar. My name is Renato Prieto, and I'm absolutely delighted to be your host for today as we explore the health of this bull market in both stocks and bonds, maybe a bit more bullish for some asset classes than others. And for that, we'll have distinguished panelists to opine on that. But before we start, one word of praise, acknowledgement to Evenco for setting up yet again another safe space for debate for our community of PMs, analysts, and asset allocators, so that we can debate old ideas and new ideas. Evenco is also proud to put together live events where I think there's about 15 events left this year in that triangle between Oslo, Chicago, and Valencia. So I'm sure that at some point we will be at your door. This event is not only powered by Evenco, but it's also powered by Bloomberg Intelligence, the research arm of Bloomberg. Some of you might know that this is perhaps the biggest independent research house in the street. We boast over 475 investment professionals with more than 15 years on average of market experience. And we cover everything from equity and fixed income strategy, which we'll touch on today, down to the remits of credit single names, litigation, and even aircraft leasing if you are so inclined. The good news is that if you have a Bloomberg terminal, you already have Bloomberg Intelligence. So you can either find us on BI Go, or, to be honest, because AI has not taken over yet, please feel free to ping me an IB chat later today, and I'll be more than happy to discuss how we can help you. Right. So now that we've said our prayers, let's move on. So there's two rules for today. First rule regards Q&A. I would appeal to the audience, to their generosity, to please come forward and write your questions as soon as you think them. Debate thrives on questions and questioning, so please keep them coming, and we'll make our best to include them throughout the discussion, or otherwise we will have a moment by the end of the webinar to address them specifically. So please do keep them coming. Rule number two is let's come and meet our panelists. So I'll start alphabetically, and that means Andreas. Andreas, could I please ask the panelists to be so kind as to introduce yourselves, give a bit of your background, and I guess perhaps if you could give a more tangible example of something you've been working on or looking at recently, so that the audience can have a tangible idea of what you focus on. Andreas, please.
Of course, thank you, Renato. So welcome from Zurich. As you probably have heard, my name is Andreas Bickel. I'm the CIO of Lienhardt and Partner Privatbank and Partners. I am an asset allocator and portfolio manager. As a background, I'm a trained economist, and I studied some finance on top of it. I have been working in asset allocation, asset management for the last 30 years. Thereof 25, I was responsible in one way or the other to steer asset allocations and also to manage later on portfolios. That experience is based on companies like Goldman Sachs, Rothschild, UBS, Zurich Insurance, or Deutsche Assets. So I got a fair insight of various investment processes, and that's what I try to condense and to use nowadays. And as you were asking, what was my recent research topic, I was invited to write an article about sell in May and go away. Is it actually working, this old saying? And for those who have read the article, the answer is no, not really, if you compare it to a simple buy and hold strategy. And with that framework, I was assessing cyclical, so short-term bull market, which is probably the theme of today, and also secular ones, and in which regime we are in. And my belief since 2020 is we are in a financial repression regime that has a lot of consequences. So inflation, in particular in the US, is sticky.
Andreas, we'll get into that. We'll get into that. This is shaping up to be interesting, very, very interesting and intense. Let's go. Arun, can you please give us a bit of background as well, please?
So thanks, Renato, and thanks everyone for joining this session. So my name is Arun Kelshiker. I was the former head of asset allocation and portfolio strategy for Standard Chartered Bank, and part of the Global Investment Committee. I guess collectively, together with our team, coming up with the views, publishing on the views, and my own focus was on multi-asset as well as liquid alts, and then obviously communicating that across the global client base, and then putting together or constructing the fund-of-fund solutions across our 11 international retail markets and 4 global private banking centers. It's been an interesting journey because prior to that, I sort of started my investment career on the institutional side and was part of the team. We set up Allianz Global Investors. I was a portfolio manager there and also a country CIO within the Allianz Group, and have sort of moved from that institutional side using a lot of the practices across through to private wealth. Just to share what where my current focus resides. I have been working on responsible investing and sustainable finance, which has been an interesting journey as well, sort of incorporating the policy aspects of that. And so I've recently worked with the University of Cambridge, have authored a paper together with other authors at the university on how to incorporate SDGs into equity investment portfolios using open source data. So the idea of trying to democratize our industry. I'm also the advisor for 3 ESG fintechs and have focused on ESG and responsible investing, advising asset managers and asset owners.
Great, perfect. Gaël, what about you? Tell us a bit about yourself.
Good afternoon, everyone. Good afternoon, Renato. I'm Gaël Fichan. I'm the head of fixed income at Banksys. Banksys is a family-owned private bank in Geneva in Switzerland. I'm also a member of the investment committee where we make decisions on asset allocation at the bank level. I started at Banksys on September 1st, 2020 as a head of fixed income. So as you can imagine, it's not the right timing for a fixed income guy. Just to give you some insight on fixed income, US Treasuries over the period is down more than 15%. But I'm still here and I'm happy to be here with you to discuss about markets. So previously, I was a fixed income portfolio manager at Banque Cantonale Vaudoise, which is the second largest cantonal bank in Switzerland. I was managing international bonds portfolios and also created some bond total return strategy because at that time it was negative interest rates. So we had to be quite inventive to generate positive alpha. And I started my career at Swisscanto, which was the largest asset manager in Switzerland as a high-yield credit analyst. And my focus right now is, do we have to add bond in multi-asset portfolio right now, especially with this level of yield? So it could be interesting to discuss about it.
Sure, for sure. And complaining about negative interest rates does feel something like from the past, doesn't it? Great, Nicolas. Can you please give us a Can you please give us a brief introduction about your background and what you're focusing on, please?
Sure. Bonjour. I'm joining you today from Zurich. I'm the director of the World Pensions Council, which, to make a long story short, is an international asset owners association and think tank. And so we do a lot of advocacy and research work on what we call the bloody crossroads, where asset classes, geographies, finance, and policy making intersect. And around that, we do a lot of advocacy work, and we focus a lot of our research and advocacy work on ESG impact and the notion that more and more public pension funds, sovereign funds, endowments are shifting a little bit progressively away from listed assets into private markets. And that shift is having a lot of consequences on the world economy and also consequences on listed stock markets, because there is an interaction, of course, between the two. And so this is really what we look at. And I'm delighted, of course, to join you guys today.
Perfect. Thank you, Nicolas. I guess that's. I think we have quite a diversified, to use an asset allocation terminology, base of speakers. So I guess the first question of all is, obviously we came a long way, and as you alluded, in terms of interest rates and equity markets, to start with the 2 main markets. I was wondering if you could please elaborate on how do you construct a view and how do you derive an asset allocation through that process? I mean, do you use, what kind of indicators do you put on it? What kind of inputs do you take? What kind of do you use scenario analysis? Are you more of a mean variance optimizer? How do you put the whole thing together? Maybe I could start with Andreas too.
Okay, thank you. I mean, if I take a 60-40 portfolio, so classical, old-fashioned, all liquid, all listed, it's, in my humble view, all about turning points. So you have to optimize your stock-bond ratio, so which is the performance of stocks minus bonds. In order to do so, obviously, you have to know what's going to perform better, stocks or bonds. Also, so far, all far is straightforward and easy, but of course, how you do that? I use indicators. I have a deck of roughly 100 different macro data and a lot of soft indicators. And if I were to choose just one, which obviously is not smart, but if I were to, I would choose the ISM PMI manufacturing and manufacturing new orders index and trying to estimate when we have a turning point at the lower end. So in order to increase equity, that has worked over the past 20 years pretty well. To enter, one caution here, if you do that, you are always early, you are always non-consensus. If you succeed and conventionally. However, if you fail, you know the opposite, you fail unconventionally. Unfortunately, to change then, so to decrease equity, that doesn't work. So it doesn't work on the top. So then you add more indicators like the conference board leading indicator like Centix, or in Europe like IFO, ZEW. You also use charts, but more to trim positions. And then you have to have a macro view, but not as an economist. So in English, I would say, if I put my head on as an asset allocator, I like that a lot. I use still the same ingredients or indicators, but I'm not trying to forecast where the economy is heading. I'm rather trying to forecast where the stock market and bond market, which are leading actually the economy, is heading. And then we are back to where I started with these turning points. I could now go on, but I think
Sure.
I should pass it on to the next one.
Well, there's plenty of asset allocation experience in this panel. Arun, I have the feeling you can contribute to that as well.
No, absolutely, Renato, and maybe to add some context also, and not wanting to assume that the backgrounds of people who are joining the call, but to sort of differentiate. We're talking about asset allocation, we're talking about strategic asset allocation, so that's a longer time horizon, so generally anywhere from 5 to 7 years onwards, and depending on the specific mandate. Then we're also talking about tactical asset allocation, so i.e., where are the opportunities that could be that could be achieved over the course of the next 12 months or so. So it's really important for asset allocation to talk and to effectively differentiate across the time periods or time horizons that we're looking at. I think that's the first major step. When we're actually constructing the portfolio, we will have a variety of models that will support that, but the crux is really that the capital market assumptions, or CMAs. And so capital market assumptions are the expected risk and return of those asset classes over those different time periods. And so those are the inputs that we use that will then go into an optimizer of sorts, or other methodologies, and then drive what would be our overall asset allocation. A lot of it is obviously driven with respect to the philosophy of the mandate, as well as the specific considerations and the mandate itself, time horizons, and risk appetite, and many other considerations. But that sort of generally, hopefully, will set a framework for people to go on and then make those asset allocation decisions and calls. And you talked about the indicators. I mean, there will be a manner of leading, lagging, and coincidental indicators as well. So that goes across the board. You can kind of differentiate into 3 major groupings or headings of sorts. You've got fundamentals, you've got the valuation, and you've got the technicals across asset classes. And all of those are sort of brought into ultimately what becomes the overall asset allocation. And just to share with you, so that we have seen some major moves with respect to the expected risk and return expectations from major providers. So as an example, the CMAs, capital market assumptions for one provider, sees US large cap equities over the next 5 years to be around 7% in terms of expected returns, with an annualized volatility of 16%. And then if you want to try and put that into context, the return expectation for US investment grade corporate bonds is 5.7% with an expected volatility of sort of 7.1%. Thereabouts. So again, that helps to sort of frame the overall asset allocation conversation at the outset.
Sure, thank you. Thank you for putting numbers to it as well, Arun, because that really helps making a picture.
I'd just like to add one final thing. And so the reality is that there's a large component which is talking about diversifying across a portfolio. And again, just to add the data points to it. So if you're not already familiar with it, and I would recommend for people to go and look at the CAIA table for periodic asset class returns. So if you go back to school, it's like a periodic table for chemistry, elements that you come across in chemistry. And so CAIA have innovated on that and have been issuing this over the course of recent years. And so across that table, what's really interesting is if you go back 20 years, what you'll find is that, year on year, an asset class or one that would have been the best two performing of that year has been one of the worst performing asset classes the year following. And that's happened over seven out of 20 years, if we go over that time history. And that's very clearly seen through this periodic table, the CAIA periodic table. So again, just highlights the value of diversifying across asset classes over different time horizons.
For sure. Anyone else want to add to that? I have a follow-up question for this, which is obviously, so we talked about macro indicators, but there's obviously, and performance recently has been determined a lot by central bank policy. So how do you take on these more qualitative effects? So how do you think about central bank's reaction function? Or I was thinking even QT, you might know the number more or less, have an estimate, and even have an estimate of the run rate itself, but still it's not just a linear regression or a straight input into a model. So how do you go about thinking this and inserting that in that whole asset allocation process?
So maybe I can jump on this question. First of all, we have 5 key pillars on our asset allocation, which of course, obviously, one is to assess macroeconomy based on GDP, inflation, and all of this kind of leading indicator like PMI and so on. The second one, which is quite important, it will answer to your question, is about liquidity. Liquidity from the central bank perspective, but also from the government perspective, like fiscal policy and so on. And we used to compare what is expected the market, compare what, for example, the Fed is trying to telling us. So at the end of the last year, the market was expected almost 6 to 7 rate cuts, but Jeff Powell said we just main outlook is only 3 rate cuts. So when we compare this kind of dislocation between market and central banks, I think it's important to have it in investment process, and for us is so important, and like that we can have good signals. So for example, the bond market to sell or to not to sell, and to be cautious or not to be cautious. And then as we have let's say an equity approach on our asset allocation, we're also trying to assess earning growth and valuation on equity markets. And finally, we have, let's say, like market factors, which will assess market sentiment, market trend, and also the breadth of the market, like for a bit of about timing, when we have to invest now or not to invest now.
Sure. No, that's also very important. I think, indeed, we actually wrote recently that correlations within indices were getting so low that volatility might look artificially low because correlations are so low as well.
If I may add to this, sure. If we start with the same thing, but we go one step further, which is then getting a bit of art and not a science. So the point is, at the beginning of the year, you had markets expectation 7 rate cuts by the Fed. Powell tells us 3. We had 3 in the equation. Now we are down to 2. But the key point is, and nobody knows the answer to that, is, but we try to estimate the second derivative, which is how will market participants react once they realize that it's not 7, it's rather 3 or now even 2. And as we all know, with hindsight, markets went up. So sure. We try to somehow assess that and give it to a certain probability and use it for only tactical asset allocation, obviously, not for strategic, etc. But it's quite important to see what they tell us and what actually market participants expect, and also what markets does. I mean, last example here, 2-year treasury yields went down to 4.9 after the recent weak PMI data. And then there was the auction. So normally you would expect that it jumps back above 5%. Actually didn't, and markets rallied. I hoped that this will happen. Obviously, I didn't know that, but that's somehow how we try really short term, and you can call that noise. I have no problem with that, but that's somehow we try to see if this cyclical market might run further or not.
Sure. Yeah. Sometimes you might, even if you knew the end result, you might not even guess the reaction. So I guess that's a bit the point. Perfect. Thank you very much. I guess because we spoke, I guess, in a way individually about equities and bonds. I was going to ask you, and we talked about qualitative assessment. I was going to ask you two things, and well, we'd imagine they are probably related. So how do you approach, in a way, I guess, valuations? We touched a bit on that, but the correlation between asset classes. Do you take an historical view? How far back historically do you go? Do you take a forward-looking? Because obviously equity bond correlation appears static on a day-to-day basis, but over the years has flipped. So how do you think about that? And after you answer that, I do have a specific question that I've been burning to ask Nicholas about listed and unlisted that I will save for him so that he gets ready. Maybe I don't know. Maybe Arun, can you elaborate a bit on how do you approach inter-asset class correlation?
Absolutely, and just prior to that, sort of maybe to confirm Andreas's previous comments with respect to turning points and acceleration, deceleration as you go into that. So basically, looking at the second derivative does give insights as to, I guess, in many, very loosely with respect to the actual accelerating and the decelerating trends for various pieces of data. And you can go across data sets in applying that. But I would sort of confirm and suggest that's a very good way for people on the call to start looking at some factors if they're not already doing that. Going back to the question with respect to asset class valuations. So basically, a lot of it is related and is related to the time periods that one would use. And so, for instance, the strength or the recency bias that you have with data and the extent to which you use that and the statistical methodologies that you use to try and use those data sets is quite valuable. So, for instance, moving averages is something that is fairly well understood by most people and parties, as well as actually placing greater emphasis on recent data vis-a-vis historical data, depending on, and you kind of frame that into the overall paradigm of what's currently taking place at various points in time. As we know, 2008 and the global financial crisis was a very specific point in history, and hence that has to be accurately I guess incorporated within the constructs of that extraordinary time when you're looking at sort of modeling over longer time periods. So there are things like considerations that need to be taken into account. Time periods are generally looked at over different horizons, and they all offer different aspects or different pieces of value, which ultimately fit into what ultimately becomes the mosaic application of what the view is actually determined to be. So to summarize, I mean, different time periods used, qualifying it obviously with respect to extraordinary data situations, extraordinary market situations that we've had, and then ensuring that all of those inputs are valuably incorporated into ultimately using that as a mosaic theory or approach with respect to detailing the next steps going forward.
Mm-hmm.
And Renato, maybe if I may, it will also depend about the inflation regime, for example, about correlation, that we have in normal term, let's say an inflation below 3%, we have some negative correlation between bond and equity. But when we have inflation above 3%, we have positive correlation. So we have to pay attention of this correlation between bonds and equity, especially in the multi-asset portfolios. We also have to pay attention on the, let's say, single asset valuation. For example, if we compare fixed income, let's say an investment grade corporate yield compared to S&P 500 earning yield, it's obviously it's attractive bond. But if you adjust it to volatility, it's completely different. So there is a lot of volatility in interest rates. So it's for that, for us, is quite we are not comfortable to invest in the wrong hand of the yield curve, for example, because there is too much volatility. There is the valuation. Let's say that the yield curve is inverted. There is a negative term premium. So it's for that when we try to allocate investment in equities and bonds, but in bonds there is few dimensions that we have to take into consideration, especially the shape of the yield curve, real rates compared to nominal rates, and so on and so on. So there is not just only correlation between bonds and equity, but also where we are in the inflation regime and so on.
Yes.
If I can just add into that, Renato, and just a very quick point to kind of confirm Gaël's interpretation there. I mean, so a lot of market participants will use the Shiller CAIA PE, so the cyclically adjusted PE ratio. So currently that's, I think, literally at 34 times. I think it's almost an increase of 20% of where we were with respect to the CAIA PE this time last year. So there are some market measures that are out there trying to support the narrative that obviously we do have different parts of the cycle that we try and evaluate within.
Sure. Perfect. Well, I have a question for Nicolas, which would be, as you mentioned in your introduction, Nicolas, you talked about real assets and unlisted assets, and obviously the alternatives as a blank term has been mentioned recently as a diversifier in the middle of all of this. So my question to you is, how do you approach not only as an overall asset class, but given alternatives can go from private equity in blue chip private equity to farming, how do we go about that? So how would you think about that?
So I would say that there's clearly that sort of secular trend globally across the world of pension funds and sovereign funds year after year, quarter after quarter, divesting away from listed assets into private equity, private debt, infrastructure, farming, real assets. That is reshaping financial markets. It's true, but there's a deeper force. So, connecting the dots to what you said earlier, there's an even deeper force. It's what the White House does in the field of infrastructure, private equity. What I mean is that in the past 2 years, that odd couple, on the one hand, the Federal Reserve Board, on the other hand, the White House and the US Treasury, the relationship between that odd couple has become even more central for financial markets. What I'm coming at is the following, is that, sell and may go away, correlation between bonds and stocks, all these weekly or monthly or daily fluctuations, to a large extent, they can be explained by the relationship between, Federal Reserve Board's expected interest rate setting and deficit spending by the US federal government. But what I'm coming at is something happened 2 years ago, and it's starting to have huge effect. And I would argue it will have even deeper effects in the coming quarters, is the Inflation Reduction Act, the real name of which is China's Reduction Act. And then there's the Infrastructure Investment Act. And then there is the CHIPS Act. So what happens now, we're barely starting to feel the hundreds of billions of dollars being pumped by the US federal government into the US economy, which in Asia and Europe, we cannot afford to do. And what it's doing, it's sucking away a lot of long-term capital from emerging markets, Asia, Europe, into the US. A big example of that is, all these giant Korean, Taiwanese, German, infrastructure, microchip, high-tech companies opening up new plants in Arizona, California, Texas, with these massive trillions of dollars of subsidies. And that is reshaping the world economy. And I will argue it's probably why that bullish trend is there. So the fact that, the markets, equity markets keep on rising, people are saying, oh, it's strange, the correlation with bonds is not normal. Yes, because the world is changing. And because of that sort of floor of monthly tens of billions of dollars of American government subsidies for the tech industry, for infrastructure, and it's quite predictable. I think because of that, the dynamics of Wall Street is very strong. And that's why, the Federal Reserve Board is a little bit complacent in a way. I don't think it's hawkish, I think it's a little complacent, and I think it's adjusting progressively to that new reality. And I'll conclude on that the impact of that new reality is that sticky inflation is simply a consequence of that. So the fact that people are saying, oh, blah, blah, yes, we will have 4 or 5% inflation for a long time because of that huge planned, well-thought, long-term increase in US government spending.
Okay.
And maybe as just something
wow.
to add is about infrastructure investment, about chip investment, about China Act or Inflation Act. The peak of this investment is not now, it's in 2026. It will be the most spending in 2026. So it's for that when, for example, we are assessing how the market is viewing the end of the normalization, not of easing, but of normalization of the monetary policy in US. At the start of this year, it was in October 2024, if we take into consideration that the terminal rate is at 4%. Right now, the market is expecting a terminal rate at 4% only in the summer of 2026. So the path of the normalization of the monetary policy is now we will be in restrictive monetary policy for 2.5 years, which is quite a big thing for fixed income market. So
and for equity. I mean, there were so many things mentioned before, which I have all to sign. So starting with inflation, all this money put in is a kind of financial repression. So inflation, in my humble view, is here to stay. This creation of additional GDP growth on top of it to the AI is going to have a huge impact on growth in the US, on the tech sector. And my take is it will take a secular trend, or I call it generation bubble. If it will be in 26, like we just heard, I don't know, but it will take much longer. And we heard Schiller PE. I mean, Schiller PE tells you 10 years from now, the average return per year will be pretty low. But I tell you, I agree with that because that's science or at least a quantitative model. But from here till there, we will have a huge bubble to these reasons we have just heard before. And therefore, even if I must say the US is not cheap, it would be very, very stupid for an asset allocator in the liquid space to underestimate the power of this money flow. And unfortunately, that means money is pulled away from areas we have heard, be it emerging market, be it Europe towards the US tech. And the example of the German chip producer opening plants in the States, or even Taiwan Semiconductor does the same, tells you everything. So therefore, and now we are unfortunately 2 steps ahead, but it really fits. If that is all coming together, I would argue that we have first a generation bubble, and it will take at least till 2026 till the normalization of this Fed policy or the monetary policy will materialize.
Perfect. This is a great way to go into the next question, which is what's the health of the bull and the bond of the stocks and bond market? How healthy is the bull these days?
I'm happy to kick off, Renato.
Yes,
so
please,
I think,
Arun.
No, absolutely. So basically, equities would always, generally trend higher if a recession is avoided. So the big question mark, which we've all talked about, in a slightly different way, and arriving at the narrative is the timing of the US recession. And we've also found that potentially in non-recessionary periods, pullbacks in US equities have been limited in such situations. So at the moment, we're looking at corporate earnings. We're sort of having earnings season, which have also continued to come in, particularly strongly. So I think over 3/4 of companies that have reported on the S&P have beaten their expectations. I'd also highlight that, I guess, to share that companies have also lowered their expectations for earnings going into the next quarter by virtually half as well. So they've lowered the bar effectively for beating those earnings going forward into the next quarter. So there seems to be a lot of strength that continues to be driven. The job market consumption indicators have come in strongly as of recently. And so, so potentially we are going to, so there are a lot of strong positives talking about, continuing performance of US equities, just given the sort of recent data points. that aside, there are obviously the headwinds, and I'm sure we'll talk about them, geopolitics and the like. But currently, that's the most recent analyzing the most recent data.
Yes, for sure. Does anyone want to contribute to that? I've actually one point that I wanted to raise, based on actually the number you gave, Arun, before, is even though it seems, and then again, my background is more fixed income rather than equities, but as you were saying, so IG corporates was at a 5.7% expected return to a 7% volatility, wasn't it? With yields higher, and even though equity valuations are higher, are we still seeing a tilt to equities though? Because that would, given the higher yield in fixed income, that would have suggested that by portfolio construction textbooks, you would probably over-allocate slightly to fixed income. But how do you marry those two ideas?
No,
Well,
go
ahead.
Please. Okay, so maybe just to come back on the health of the bull, not in stock market but in credit market. I think it's quite impressive actually, because the primary market, for example, it's a good indicator of how the health is in credit market, was very busy and very high since the beginning of the year. The spread concession, for example, is very tight. When we assess yield or let's say credit spread across the rating spectrum, everything is compressed. So it feels like, yes, we are quite in the bull market in credit. And just to give you some insight on the credit side, it's now, for example, when we have US investment grade corporate bond at, let's say, 5% or 5.5%, the credit spread is only 15% of the total yield. So it's the lowest ever in the history. So basically, you have not a credit corporate bond, you have a rate bond, a rate instrument. So you also have to pay attention, because it's priced to perfection, and any widening, any sell-off in equities could be also not good for credit. And what we observe, especially in European market, credit market, is at the lower quality in high yield, in triple C, we have some deterioration with idiosyncratic risk for now, but not the whole sector, but in different sectors. So we have, for example, Altis in telco, we have Arda in packaging, we have Intrum, which is a manager of distressed debt. So all this kind of thing begins to explode. So we have to pay attention. There is no contingent and only idiosyncratic risk. But otherwise, yes, for sure, we also see some bull market in credit for sure.
Good. Perfect. Anyone wants to diagnose any extra diagnosis on the bull?
Well, the question is in which currency. If I talk dollar like you just did, I cannot add much. If I talk in Swiss franc, where I get 1 to 1.5% and I have an inflation of 1%, good luck with that. And the other thing I might add is we don't invest right now in high yields or corporate with lower quality for the reason just mentioned. The spreads are tremendously tight. And therefore, I was brave enough to write some months ago, the US recession will not take place because the spreads were continuing to get compressed. And there was no rise in default rate, although everybody was talking about that. And normally bond investors are smarter than equity investors. Having said that, look at the yield curve of govie bonds, and that's the conundrum, because you have 10-year at 460 roughly, 2-year at 490, and treasury yields even above that. It's still inverted. It's the longest inverted period on record. And still, I keep repeating it. I don't think we will see a US recession anytime soon. Of course, in 1 to 3 years, for sure, there will be one. But at the moment, no. And therefore, I would agree with the bull. However, it is a bit hard to see where the additional return comes, because if you tell me yields are going down, but the Fed is not going to cut, then I must tell you the yield curve stays inverted, and that cannot last forever. That's my conundrum here.
Sure. Nicola, anything to add from your side, given your overview of pensions?
No, I would agree with what Arun and Andreas and Gaël said. I mean, I think it's going to be quite interesting to watch the decorrelation within G7 OECD countries, because historically the economic cycle within G7 OECD
Yes.
is quite nicely, correlated. I think now, because of America is sucking away so much capital, not only from emerging markets, but also from Europe, I think what we may see in the coming quarters is the default rate on European corporate bonds, not even like fairly well rated European corporate bonds. I think the degradation of the quality will be obvious because there isn't enough growth. So I think the growth engine is broken in the EU. It's true that in the past 5 weeks, the data coming from Germany and France were less bleak or less bad than in the previous quarters, but I think it's a one-shot statistical anomaly. I think the medium-term trend when it comes to European industry is bad because there is less and less innovation. So it's not only AI and high tech, and it's in all fields of industry. It looks like Europe is unable to innovate, create, etc. So America is sucking away capital, but it's also sucking away patents and innovation. China is doing quite well in spite of all the pressure which America is putting on the Chinese economy. China's doing kind of okay-ish. So I think we may see some negative news from European corporates and European government in the coming quarters.
Wow. Okay. Well, that's great. That's great to hear. I guess with that, on that note, we can probably talk a bit more about upcoming risks. So I was maybe we can look, and I think Arun, you brought up geopolitics, albeit briefly. Maybe US elections is perhaps the geopolitical point in everyone's mind, and probably has the most common effect across the asset classes being discussed here, from the now renamed China Reduction Act to effects across interaction with central banks and political decisions inside and outside of the US. I was wondering how are, in considering that there's a layer between strategic asset allocation and tacticals, how are you approaching US elections? And if I could add, is there a point at which, and I think Andreas, you mentioned this in your piece about US elections being an opportunity, and it's exactly that, like, when does an election that is visible goes from risk to opportunity?
May I start?
Of course, please.
I had the pleasure to have Ken Fisher, research guy, in the house, and they were enlightening me. So I would never dare to say as a European citizen that I'm an expert on that. Nevertheless, I have a strong opinion. As long as in the US election, we have divided parliaments and or even both parliaments are taken by the same party, but the difference is so small, and inter-party, they have so much disagreement. It's like divided parliaments, and then it doesn't matter who wins. This is a quite contrarian view. However, this is a quite likely outcome, and therefore it would be, if that's going to happen, it's rather an opportunity. And a bit more general for those who haven't read the article, normally from now till the election, there will be a pullback. Don't ask me when, don't ask me how much. I cannot time that, so therefore stay invested at whatever asset allocation is suitable. However, if that's going to happen, I recommend, if history rhymes, then you should add to risk if such a correction happens. But feel free to disagree. But the key point is, as much as we know today, I would say at the moment, this election, given that the outcome is a bit a mixed bag, that everything is lame and can't move, it's rather an opportunity.
Right. Well, we can also agree in different manners, maybe. Arun, do you have a view on that?
Yeah. So what I'd say is, I think I can talk about currently the fact that, okay, we talk about an election year, but this is potentially the election year. So we've got close to 4 billion people going to the polls. We've got elections in some of the most populated countries in the world and regions as well. So UK, India, US, Indonesia, and the European Union. So we've got at least 64 countries going to the polls over the course of the next 12 to 18 months. And if I look at the past election years of just what the performance has been, irrespective of the outcome, then I think over the course of since 2000, we've only had, and all of the elections that have followed since that time, we've only had two occasions when the S&P has performed negatively. So that was in 2000, and that was also in 2008. And then just interestingly, I did sort of have a look at the S&P since its inception as to how many negative years there had been during an election year. And out of those 23 election years that we've had since the inception of the S&P, you know, we've basically had positive performance in 19 out of 23 election years. So that's, you know, we're going back almost 100 years, just a little bit under, but that's quite a data point. So I think that there's a lot of data supporting the idea. If you kind of, you know, let's say that, you know, every election year had its own specific narratives and very unique situation circumstances, but just looking at those data points at the headline level, you know, do support some of the current narrative around the S&P and potentially equities performance this year.
Sure.
May I just throw in one number? There were these 23 election years, and the average return was an astonishingly 11% based on Ken Fisher research. I haven't double-checked the number, but the point I want to make is, even if you include the 4 negative ones, the outcome of the 4th election year on average, and that's the problem here, on average, was pretty positive.
Okay, no, that's a good one. That's a good one to keep in mind, I guess, for dinner parties inclusive. Gaël, how do you see things from your fixed income point of view?
Maybe if you want to add something about observation, is when we have a positive month in November, December, January, and February in the S&P 500, 100% of case, we have a positive returns over the next 10 to 12 months. So it's another positive observation. I'm a bit more worried about US election on the fixed income side, obviously. Worried about emerging market if there is any conflict with China, direct conflict, let's say like that. And also if there is any fiscal policy slippage from Trump, for example, or even Biden, because either Biden or Trump could have to accelerate fiscal spending. So it's not good for, obviously, for fixed income, but I think for risky asset, it's not bad, except if there is any direct conflict with China.
Nicola, for your reduction acts, is there a risk?
So I think not, because I think it's a paradox. It's a big American paradox. There's a lot of continuity between Trump and Biden. So, you know, they don't like to say so. And if you read the New York Times, you know, they hate each other and they're very different. But actually, there's a lot of continuity on the foreign policy, military, fiscal, and economic front. One of them is neo-Colbertism. And so really what America is doing now, it's reverting massively to 1930s style state capitalism. And it's really state capitalism on steroids.
With higher debt levels, though.
Yeah, and I think nothing's going to change it. So either Trump or you know, whoever is elected, to be honest, because that trend of an accelerating technological, financial, economic race with China is there to stay. It can only accelerate for reasons that are above and beyond what Biden or Trump or Democrats think. And so because of that, the temptation to, you know, keep on pumping money into the defense and tech and microchip industries will be there. So deficit spending will be there. And I think the Americans can afford to, it's a cruel irony for us in Europe, but for many reasons, the Americans can afford to do that, which we cannot do. So when France or Italy reach a debt to GDP ratio similar to America, you know, all hell breaks loose. But the Americans, to be honest, can keep on doing it for a few years. So I think, you know, that is one more reason why I would say personally, I think that bull market will keep on, you know, riding that wave of, you know, self-fulfilling, you know, self-fulfilling government-sponsored bull market. There's nothing to stop it in the US.
Sure. Actually, that's a very good point, Nicola. And I guess I'll take that point about the funding, as I guess is the risk to all of that. The not being able to fund or a crowding out effect at some point. I was wondering, and also to address one of the questions from the audience, Are there any significant unknowns or misestimations that you see in the markets that investors should be aware of? And I'm taking that point from Nicola, because again, higher debt levels could be a topic for 2025 eventually. And as we enter, for example, the first time in a long time where all the major economies are in QT mode. So I was wondering, does anyone want to throw Henry Kinsiger's famous unknown unknowns into the arena?
The Fed could raise rates without first cutting it. Larry Summer was the first guy who mentioned that. And if you look at the economy, if you look what we have just heard regarding putting money into the system, there is no need to cut rates. However, if they were not to cut, then they lose full credibility. So my educated guess is they will cut at least once. But the risk is that they will realize data dependent, actually we should start to raise rates and inflation might be sticky above 3%.
Great. Yes, sounds great. Anyone want to throw another one?
So I mean, I'd like to, I guess, look at it with a slightly sort of mid to longer term horizon, and we sort of focus on the transition across to a low carbon economy. And also the material impacts of that. So, for instance, we think about the physical risks, which will be impacting, which are continuing to impact asset prices, as well as the transition risks, which companies and societal stakeholders are now facing. You saw the impacts across the board: energy prices, economic growth, energy production and consumption, and so the transition has a very large role to play, and the extent to which it's currently being factored in or priced is also somewhat questionable. There is an even larger conversation with respect to the way in which it's currently being modeled into strategic asset allocation. And the challenge is that people are talking about how effectively tipping points. So the idea that there is a tipping point, which is something that's very consequential in terms of natural capital, how effectively tipping points can actually be modeled in. And just to share with you how some of the forward-looking asset allocators and some of the largest institutions in the world, including USS, which is the UK's largest pension fund, they've got assets under management of around 75 billion, are actually looking at it, is that they're looking at evolving what is strategic asset allocation to incorporate a narratives-based climate scenario analysis, which then filters through their investment process and then is incorporated. And a couple of dimensions which they've added into that mix to try and drive coming up with more valuable inputs for their climate scenario analysis, which then translates through to ultimately, implications for asset pricing, as well as macroeconomic factors, include things like policy coordination and technological development. And just finally, the other sort of pragmatic approach they took is that normally climate scenario analysis will go into very extended, longer time horizons, 2050 and then possibly beyond that. But they've also gone into a far shorter time horizon to try and really pragmatically drive what the implications will be. So they've gone to 2030 in terms of revamping their climate scenario. This narrative space, their approach to a narrative-based climate scenario analysis, which then is filtering valuable inputs into their strategic asset allocation.
That's very interesting. Actually, well, there could be a webinar just on long-term themes and implications and how they interact with one another, which is, I guess, probably the phase where we are now with thematic investing. So AI, we start realizing that it raises energy requirements, and then all the things that it feeds through. Arun, thank you very much for that. That was great. Gaël, do you have a favorite unknown you would like to share with us?
Maybe two things. The first one is if the market is pushing a lot of pressure on Bank of Japan to be more aggressive on the normalization, I think it could be of the monetary policy. I think it could be very damageable for markets. And the second one is if the Fed will raise the long-term dot plot, it could be also damageable on the fixed income side, obviously. And so we have to be prepared for this kind of scenario. Of
course. I would add, and that's obviously because I work for Bloomberg Intelligence, that we also produce models that extract risk-neutral probabilities from the options market. And at the moment, our models are pointing to just over 20% chance of a rate hike by December 24. So for you guys to have an idea, this number was at around 4% in January. So it's becoming realistic, even though the futures market still prices a 1.5-ish cuts for the year. That's great. Nicolas, from your standpoint as in being in touch with so many pension mandates around the world, what's the unknown?
Yeah, I mean, to use the Don Rumsfeld metaphor, you know, the unknown, I think that the biggest one is because of back to, you know, that neo-Colbertist deficit spending. A lot of money is going to defense.
Mm-hmm.
So not only domestically, but also internationally. And we saw it in America 4 days ago. It's nearly, you know, $100 billion of extra defense spending that the Congress passed 4 days ago for weapons to be sent to Ukraine, Taiwan, Israel, etc. My point is, if you keep on spending more on defense in America, Russia, China, etc., and if a lot of these weapons go to the theater of action, you know, once again, Donald Rumsfeld, you know, if they go to Eastern Europe or the Middle East or the South China Sea, and if week after week, months after months, you keep on piling these sophisticated weapon systems, my fear is that, you know, it could blow in our face. So I think, you know, we may be sleepwalking into war. And the same is happening in this sort of, you know, EU versus Russia. Every month or every 2 months, the EU passes a new anti-Russian package. I think it's the 16th or 17th package, becoming ridiculous. But I mean, it's tit for tat, because every time they pass an anti-Russian package, the Russians pass an anti-EU package. And so what I'm coming at is there will be consequences, deferred consequences, but I think we're piling on governments, not
Sure.
the private sector, but are piling a lot of risk, and these risks may explode in our face down the road.
That's a good point, and thank you again, Nicola, for making the segue to another question, which is how do you, when you're thinking about your asset allocation, how do you go about this? Is it or be it at the strategic or tactical level? Do you just, you know, increase the risk premia consideration? Do you avoid a specific sector or geography? Do you hedge momentarily? How do you go? How do you go about thinking about all these topics? For example, are you avoiding Middle East MENA at the moment? For example, are you avoiding anything that is CEMIA related?
Yeah. I think, you know, pension funds are not divesting from MENA. I mean, pension funds haven't historically been big investors in MENA, but on the contrary, and it's a paradox, the UAE, Abu Dhabi, Dubai, and Saudi Arabia are kind of profiting from the situation. So there is net new money going to Saudi Arabia and the UAE. What's more important, there are many pension funds and sovereign funds divesting away from China because they are afraid of being caught in the crossfire, because many of their investment in tech and infrastructure in China can be overnight redefined by the State Department as dual use. And so pension funds are risk averse. They're divesting away from China. They're investing more in Mexico, Indonesia, Malaysia, etc. India is a big winner in that sort of, you know, thing. And one last thing I want to say is that sovereign funds and central banks in the Middle East and Asia and Latin America are buying gold. They're buying gold like never before since the year 1972. And that is also something new.
Perfect. Great. I think we ran out of time. So thank you all very, very much for this insightful 1 hour, which went by like 10 minutes. So thanks again. I will recommend the audience. I know there's a few questions still left to answer, but we are amongst the most amicable of panelists, so I'm sure they wouldn't mind if some of these people reach out to you directly with some specific questions. So we have things regarding the Reduction Act and its effect on yields. We also have some questions about the interaction between Fed, banks, policymakers, given, I guess the background would be what we've seen in the US banking scene. So feel free to. Thank you very much for this. From my part, it was an absolute pleasure having this discussion. I will look forward to catching up with all of you as well afterwards, because, you know, questions, answers to questions raise further questions. So, and I guess that's the point of these debates. And once again, Evenko, thank you very much for putting this together. And we'll see you at the next Trend Watch. Have a good day, everyone.
Great.
Thank you so
Thanks
much.
very much, everyone.
Take care.